So remember, in the very beginning of this presentation, I talked about the income statement. This is the sample income statement that we've built using for our catheter company as we've used all of our assumptions and built all of the different tabs that you've looked at so far. The first line in an income statement is the revenue line. So we pull this information directly from the market model. The market model tells us how much we intend to sell each year. The next line is the manufacturing costs line. So here's an example of our manufacturing costs from year 3. This number comes directly from the cost analysis spreadsheet when we looked at the COGS, or cost of goods sold, section. We use these two numbers to calculate the gross margin. The next piece of calculation that we need to do is determine all of our operating expenses. All of this information is going to flow directly from the cost analysis spreadsheet, where we look at our R&D costs, our SG&A costs, and even our facility costs. You go ahead and add all of those things up, and you can determine your total operating expenses on a year-by-year basis. One of the things we can do in the model is calculate ratios. Some of the most important ratios are the percentage of sales that the gross margin represents and the percentage of sales that the operating expenses represent. People who build a lot of these models will look at these percentages to compare your business against all of the other businesses that they've seen. In particular, investors like to look at these ratios all the time. The best place to understand what good numbers are for the cost, for the gross margin and the total OPEX as a percent of sales is to go out and look at the public companies that are out there on the internet. So, for example, if you were to look at Medtronic, you can see what percent of their sales they spend on operating expense and what percent they spend on gross margin. You can also start to break these things down to determine how much money you should be spending on R&D, sales and marketing, and even facilities. This information is critical to help you check whether or not your model is actually realistic. So the typical gross margin percentage will depend directly on the type of product that you're building. If you're building a software product, there is not a lot of manufacturing costs that go into building software. So that means your gross margin percentage will be extremely high. If you're building a very complicated implantable device like an implantable defibrillator, your gross margin is going to be lower because your manufacturing costs are going to be much higher. In this particular example, 72% margin is actually kind of on the lower end for medical device companies. When we look at other things like the R&D costs and SG&A costs, the best thing to do is to look at the public company that is most similar to you, whether that's Medtronic or Stryker, or if you're doing online things, you can look at WebMD. So these will give you a better sense of what these ratios should be. A typical ratio for the percent of sales on the R&D side is about 10%. That's a pretty healthy amount to spend each year on R&D. So imagine spending 10% of all your revenue every year on new products in R&D. That's pretty healthy. Unfortunately for engineers, selling and marketing of devices is actually much more expensive than building them on the R&D side. So what we tend to see is 3 to 4 times the spend in SG&A that we do in R&D. This makes sense if you think way back to our staffing plan. This makes a lot of sense because we're usually having 3 times the number of selling general administrative people to the number of engineers. Last but not least on the income statement, we calculate something called the pre-tax operating profit. So this is the yearly profit and loss associated with your company. If you look at our catheter company example, you're actually going to see that this company, despite all of our interesting, cool technology, actually loses money for the first 6 years of its life. This is a very common thing in medical devices. It takes a long time to become profitable. But once you do become profitable, these businesses tend to generate a significant amount of ongoing operating profit.